Okay, everybody, welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Ryan Kimmel.
Yo, yo.
It's about 10 a.m. Pacific today, August 8th, 2025, 8/8. Just interesting factoid, 8/8, 2008 was the start of the Beijing Olympics, which was widely seen as kind of tour de force of Beijing's entry into the global economy, or China's entry into the global economy. I vividly remember that day. I remember where I was. Some of you probably remember where you were. Kind of interesting how things have gone full circle now that we're kind of in the midst of Liberation Day 2 and the wrapping up of many trade deals. And this tension has kind of gone full circle. So, with that, we'll kind of jump into the bloodless verdict of the market and see how this week has treated us. Last Friday was pretty interesting, as I was kind of alluding to. There was a bit of the Liberation Day 2 fear, which caused a rate rally and caused some volatility in the stock market. But on a week-to-date basis, the S&P has rallied actually back from that. Not fully, but rallied quite a bit. So on a week-to-date basis, the S&P is up over 2%, over 2.25%, with the leading sectors being consumer discretionary up over 3.5% and technology up 3.25%. The laggards this week are the healthcare sector down about 75 basis points and the utilities sector, which squeaked out a gain up 0.25%. Kind of when you look at the equal weight indices, the S&P equal weight index is up about 1%, and the Russell 1000 growth is up over 3%, while the Russell 1000 value is only up about 1.4%. So clearly it's a growth scenario. It's back to animal spirits, and kind of a little bit of that fear has dissipated as the headline risk has faded into people's memories. It seems like everybody has a short memory these days. And so that kind of gives you a view on the equity market. Pretty solid week for equities, though there was that drawdown on Friday last week. And then if you look at, the and part of that we talked about on minutes last week. I wasn't here, but was the jobs report, which was pretty lackluster, which led to the firing of the head of the BLS. But anyways, kind of moving along to fixed income land, we saw a pretty big rate rally last Friday. The 10-year closed at 4.22 on Friday of last week. But as we sit here recording right now, the 10-year US Treasury is at 4.28%. So a little bit of consolidation, trading in its range that it's been in for some months now. And that kind of leaves the broad fixed income market down slightly on the week, down 17 basis points on the week if you look at the Bloomberg US aggregate. But on a month-to-date basis, the ag is still up 64 basis points because you had that strong rally last Friday. And, if you kind of drill into the sectors, the weakest performing sector, no surprises this week, is governments, down about 0.25%. While you had positive news in the high yield markets, up about 39 basis points. Bank loans are up about 10 basis points. Emerging market bonds are up over 60 basis points. So a bit of a dispersion there with, those interest rate sensitive assets losing value while other assets have appreciated in value. So that's kind of a interesting takeaway from my point of view. And then if you kind of roll over to the commodity markets, well, on a broad basis, the Bloomberg Commodity Index is up 39 basis points on the week, but you do have some dispersion there. You have the energy subcomponent down about 3%, as it looks like maybe we're going to see a detente between the United States, Ukraine, and Russia regarding the Ukraine war. There's been a lot of headline risk that's given volatility to oil prices, and especially downward pressure there. President Trump has been talking about secondary tariffs. There were tariffs put on India for consuming Russian oil, but now we have news of a potential ceasefire that may occur if President Trump and President Putin meet and are able to broker a deal that the Ukrainians can pallet. So there's just a lot going on there, but it's weighed on the energy market. As I said, energy prices are down 3%, with WTI crude sitting at $64 a barrel and down about 4.5% on the week. So that's some market moving stuff. Though you do see precious metals up 3%, industrial metals up 1.5%. So you have some pockets of growth there in the commodity market. The bellwether Dr. Copper's up 88 basis points on the week, and gold is up 2.7%. As we sit here recording this podcast, gold is trading about $3,400 an ounce. Now, the interesting thing about gold is it's wildly changing right now as we speak. There's a lot of drama regarding tariffs. We have the U.S. Customs claiming that 1 kilogram um, gold bars are subject to the reciprocal tariffs that President Trump put on, including the tariffs on Switzerland. And it also applies to 100-ounce gold bars. And so there's just a lot of uncertainty as to, is that true? Is that not true? Is that going to stick? As many of our listeners may be aware, Switzerland is a major repository of refined gold, and there's a lot of gold refineries there. So that's definitely could weigh on markets, as if transfers of gold into and out of the United States are subject to duties. So that's something where we'll keep you guys apprised of. But as of right now, gold's up marginally on this news, but there is a spread you're seeing between gold in the United States and gold elsewhere. And you kind of saw that same dynamic in copper, if our listeners remember, a few weeks ago when President Trump put a tariff on refined copper entering the United States. And, we saw a huge disparity in copper prices between London and the US. And then he pulled that off, and we saw a convergence of price. So I think a similar situation could happen in gold. So it's something that's topical and something to keep an eye on. And last but not least, we'll look at kind of the currency markets. The dollar index is currently trading about $98, down 1% on the week, and Bitcoin sitting at $116,000 per Bitcoin. And that kind of wraps up where we are in the markets for the week.
Yeah, the only thing I would add, just as far as the markets front, is that yeah, after the fireworks we saw at the end of last week, seems like risk assets are finding some comfort out there with it looks like the Fed is more inclined to maybe cut rates or biased to cut rates now. You're getting market pricing in more rate cuts following that payrolls report and some dovish commentary from some Fed members out there this week. And that's on the back of, solid earnings this for the second quarter. I think right now we've seen about 84% of the companies have reported so far for Q2. And of those that have reported, 74% have beat on earnings expectations, and EPS growth is now running at 11%. Higher than the previous year. So pretty big upgrades to the earnings trajectory. So, fundamentals kind of intersecting with maybe a lower rate environment. I think that's really supporting risk assets. And then just on a similar vein within fixed income and just looking at rates, one interesting data point is looking at the MOVE index, which is, implied interest rate volatility across the curve. Just looking out like 1 month expectations, that's basically at the lowest level since Jan 22, which is before the Fed hiking cycle even started. So it looks like the market is kind of not really expecting too much in the way of fireworks over the near term, at least, both on the interest rate front as well as the equity markets.
Yeah. Yeah, I agree with you, Kimmel. I think you bring up some good points. I think that, traditionally August is a quiet month, but deal activity on Wall Street's actually been relatively elevated. So, it is interesting that markets are sanguine right now, but I definitely think there's a potential for, some moves come the fall. But it is what it is. Here we are. So let's roll into the macro for the week.
Yeah, it was a pretty quiet week on the macro front after very busy data reporting week on the week prior. So not too much really to highlight. It's really just like tier two data. Starting off on Monday, we got the final release of the durable goods orders revised down marginally 10 basis points to negative 9.4% month over month for June. Again, that was driven by 52% decline in aircraft orders, which is, very volatile component. If you exclude those aircraft orders, the transportation segment orders were little changed, up 20 basis points on the month. And again, some stats that I like to highlight from this report are just core capital goods orders relative to shipments. And we did, continue to see that the level of orders is below that of shipments, which can be a negative signal for investment growth in the months ahead. So something to keep an eye on. On Tuesday, we had the ISM Services PMI, which declined for July to 50.1, which is just above, or just barely in expansion territory. If you look at the underlying details of the report, though, pretty weak. New orders that declined to 50.3, down from 51.3 in June, and then the employment component that decreased further to 46.4, so well below 50, which is contractionary territory. And you're seeing weakness of these employment components both in the services and manufacturing sector. So and you've been seeing that for quite some time now, so it's kind of interesting now you're finally starting to see some of that weakness feed through into the some of the official data like we saw last week in the payrolls report. Also on Tuesday we had the June trade deficit, which reduced to or narrowed to 60.2 billion, which is largely in line with expectations. This was led by a fall in imports of 3.7% month over month. And really, this has been very volatile just around, the front running of tariffs. But with a narrowing of the trade deficits, that does point to a more constructive impulse to GDP from net exports. On Thursday, we got initial jobless claims. That increased a bit more than expected. It is up 7,000 to 226,000 versus consensus expecting 222,000 in claims. It really hasn't been moving too much. For the 4-week moving average, pretty stable at 221,000, which is kind of near 3-month low. On the continuing claims front, you saw that rise of 38K to 1.974 million, which is a cycle high after some revisions. I do remember seeing some initial reports maybe above 2 million prior, but those were revised lower. But again, what you're seeing here is no real significant warning signs as far as layoffs go, but it does look like those that are being laid off, it's just taking them longer to find work. But nothing really here as far as warning signs go. We did get also on Thursday labor productivity for the second quarter. That did accelerate more than expected. You had non-farm output per hour rising 2.4% annualized Q over Q. That was against the previous quarter, which was revised lower to a decline of 1.8%. So again, pretty volatile numbers here. When you kind of smooth it out and look out over the past 4 quarters, you're seeing productivity running around 1.3%. So definitely not, super high productivity numbers. And UBS had an interesting kind of quote following the report. They said, in the last 22 quarters since the end of 2019, productivity has risen 1.8% at an annual rate, a touch better than the 1.6% trend we estimated from 2003 to the 2019 period. So you're not really seeing, a massive rebound or acceleration in productivity yet. But, we'll have to wait and see how, the greatly anticipated productivity boost from AI comes through. But, that could take a number of years to show itself in the official
Yeah,
productivity
everybody's
data.
claiming everybody's claiming AI is going to be the next, technological revolution, and we definitely think that there's going to be some marginal productivity gains there. But you bring up a good point. We're not really seeing a massive boost in the numbers right now, so it could be a while for those kind of productivity gains to really make their way through into the real economy.
Exactly, exactly. And we had no data come out this morning, so that wraps it up for the week on the economic front.
Yeah, pretty light week though. You kind of gave a good synopsis there. As we kind of previously touched on, the interest rate markets are predicting one Federal Reserve cut in September, and looking out through year end, pricing in about two cuts, obviously subject to changes in labor market conditions. But I think that that's kind of the baseline right now. It was kind of interesting. President Trump floated yesterday that he wants to nominate an economist, Mr. Moran, to the Federal Reserve, which he's definitely one of these like trade um, rebalancing philosophy type people. Do you have an opinion on that, Mr. Kimmel?
Yeah, I read an interesting article from Nick Timmerhouse from the Wall Street Journal this morning, just saying that I think he has pretty contrarian views to kind of what's been typically reported out there from the Fed and maybe more traditional economists out there. He's really saying as far as like inflation goes and the impact from tariffs that it shouldn't really have a material impact from tariffs. So I definitely think his addition to the board, probably it's just adding a dovish Fed member. And we saw two dissents at the July meeting, and it's likely that this guy would vote for a rate cut as well. So I definitely think that the composition of the Fed with his addition is getting a bit more dovish.
Yeah, I read a report of his that he published last night, and yeah, I mean, in that report, he lays out why he thinks that the tariff impact on inflation is going to be de minimis. And he cited the example of the previous tariffs in 2018, and then he had a lot of kind of macroeconomic factors. He has definitely alternative views to mainstream economists, so I agree with you. He's going to be a dovish voice on the Fed, and he's going to maybe shake things up because I don't think he has like a lot of experience in the Federal Reserve System, if any at all. And so a lot of these Fed governors are kind of groomed to like the thinking of the Fed and the philosophy of the Fed and the culture of the Fed. And so this could be kind of a guy who's just an outsider in there, injecting a different point of view. So I am curious to see how that shakes out. But we'll definitely keep you guys apprised, and we're gonna have to wait for that next Fed meeting on September 17th to see how that goes. And looking ahead to next week with respect to the economic data, um, it's definitely a busier week than we had this week. I think that some of the things to highlight, we have the NFIB small business optimism print coming out, not the biggest thing, but then we get CPI, and we get that on Tuesday, so that's going to be definitely a market moving indicator. And we get PPI on Thursday, which is definitely going to be another market moving indicator. And then we get retail sales on Friday, along with the University of Michigan data. I mean, what's your opinion on what's coming out next week, Mr. Kimmel?
Yeah, I think all eyes are going to be focused on that CPI report, and specifically the core CPI report, ex food and energy. It does look like the consensus is looking for an acceleration to positive 30 basis points over the month. And I was looking at, some of the CPI fixings. They're calling for positive 31 basis points. So it's going to be interesting. And you also got to look under the hood to see, are we seeing further impacts from tariffs into the core goods component? And is that going to be offset by maybe further deceleration in the shelter components and the super core components? So Definitely some interesting dynamics there and could have some significant implications on, Fed pricing.
Yeah, I agree. So definitely keep your eyes peeled for next week, especially Tuesday and Thursday and Friday, from an economic standpoint. And that kind of wraps it up for the week.
Yes, thank you to our listeners out there today on on DL Minutes. Hit us up on X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
You can find more information about DoubleLine at our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/doubleline capital. One thing that I'd like to highlight for our listeners is check out the webcast on structuring resilient and asset-backed credit markets. I think it's a good webcast and it's a topic du jour, as a lot of capital is going into data structure and infrastructure investments for the AI age. And I think that this webcast offers DoubleLine insights into that space and opportunities there. So check it out. And I hope you enjoy and have a great weekend.
Yes, thanks everyone. Take care.